Welcome, Breakout Traders, to Breakout Trading Answer, the show where we talk about all things breakout trading, of course. We have our special guest, Mr. Breakouts himself, Thomas Nesnetto. Welcome, Thomas.
Thank you very much. Nice to see you guys again. And today we will talk about a very interesting topic, that is, can actually algorithmic trading, and especially algorithmic breakout trading, beat the market?
Oh, that's a good question. That's a good question. We hear a lot in the financial media about hedge funds and things like that are compared to the market. Can they beat the market? There's a lot of talk about perhaps you can't beat the market. So what about algorithmic trading? We're in it to make some money, but is it worth it?
And we will show you. We will show you on exact numbers. No kidding. Exact numbers, exact stuff, down to the earth. So shall we begin?
Yes, we should begin. Let me put up the
guys,
slides.
So I have prepared a presentation where I'm going to, let's say you have $10,000, and I'm going to guide you step by step what would happen if you would invest $10,000 into an index 5 years ago, and what would happen if you would use that $10,000 for algo trading. So let's get to it. So let's imagine you are an investor 5 years ago. It's 2023 right now, so 2018, and you have $10,000, and you say, okay, I'm going to invest into index. So the most usual index to invest in is, of course, S&P 500. Now you have a couple of possibilities to invest into this index, but the most common one is the ETF, which is called SPDR, SPY. When you basically take your money and you buy number of shares that you can buy for $10,000, and you invest into the index. So what would it look like 5 years ago? So 5 years ago, let's have a look on the next slide. If you have $10,000, the price 5 years ago was approximately 280. So 280 would give you 36 shares. Okay, so you would buy 36 shares of your SPDR S&P 500 index, and that would be your investment. And now you would be sitting on that investment, and you will be waiting what happens in 5 years. And we can see some nice growth during that 5 years. And actually, that 5 years would result. You would be nowadays. You would be exiting approximately at 413, which means your profit would be 36 times 413, which is exit price, minus 280, which is the entry price. So your profit would be $4,788. So approximately you would make nearly 50% in 5 years, which I think is pretty consistent with the overall summary of average annual return on indexes. I think it's usually claimed to be about 9-10%, right, Andrew?
Yeah, that's about right.
Yeah. So far so good. We're clear on the investment in index.
Yep, very clear.
Very clear. Now, if we want to do this algorithmically, if we want to take same $10,000 and put it into algo trading strategy, we need to understand that it works a little bit differently. So let me just very quickly recapitulate why it's different. It's not that like you put your money somewhere and it's being in the market the whole time, because here in SPDR, we're in the market all the time, every day, every minute, every second. With algorithmic trading, it's different. So let's see what it would look like with algorithmic trading. So with algorithmic trading, if we have a look on the next slide, we basically, oh, sorry, I forgot, drawdown, risk, I forgot about the risk. Okay, I forgot about the risk. So also, to be fair and to put it into perspective, what would be your risk for this SPDR investment? It's called drawdown. So basically, the worst drawdown would be from 470 to 360 in the price, which is 110. And since you hold 36 shares, you would be, for a temporary time, you would be down $4,000. So that's basically the drawdown. So you would make about 50%, and your risk or drawdown would be about 40%. So the ratio is nearly 1-to-1. Okay, I hope that's clear now. Now we're
Okay, so let's
completed.
let's just
Yes.
summarize that. So we've got about 10% annual return, not quite, but pretty close over the 5 years, with a 40% drawdown. Is that right?
Yay. That's
Round it.
totally right. Yes.
Thumbs up. Okay,
Yes.
good.
Okay. And now we finally get to algorithmic trading. Stay with us. This is going to be super interesting. So first of all, if you don't understand fully how algorithmic trading works, we strongly suggest you go back to the previous episode, which we released just recently, called How Does Algo Trading Work? You just click on subscribe, please. Be with us because we're sharing way more content that actually can help you to become rich. And in the previous episode, we talked about the 3 steps of building algorithmic trading strategy. And we already know that algorithmic trading strategy doesn't stay in the market the whole time, but it works on it just trades certain pieces of market where we have strong probability to make some money. So in a sense, it looks like this. If we go to the next slide, we can see that the whole idea of algorithmic trading is that we pretty much pick pieces of the charts. We're not the whole time. So, here you can see, for example, we buy just before these green bars going up, there's a small buy signal, and then we exit at the top of these green bars, and we have a small profit. And then each profit, each trade like this is the algorithmic trade. Like we enter for a very short period or medium-term period of time, and we exit. We're not in the market all the time. And each time we either book in some profit or loss, and all these, that's the algorithmic trading part. And then all these trades are booked in like on the spread on the table in the behind. And we create, during 5 years, we create a table of our PLs, profit and losses, of these algorithmic trades. So we're maybe just 20-30% of the time compared to the investment. We're 60-70% of time, 80% of time we're staying away, and we only go in and out when we have a good probability of the market being synced with our algorithmic or statistic finding. So that's different. That's different. So what it would look like with our $10,000? I pulled out a strategy which I finished just very recently, and if we have a look, it looks like this. So it's a simple strategy, which again I finished it last week, and it's a strategy on E-mini S&P. So E-mini S&P, it's like Spider. Like we're trading equal vehicle, almost equal. Just E-mini S&P, it's better for algorithmic trading because there are some better regulatory rules. Like you can get in and out. With Spider, your account would have to be $25,000 if you want to go repeatedly during the day in and out. With E-mini S&P, we have we still can do it with 10,000. There's no this kind of regulation, and the correlation between Spider and E-mini S&P is very close to 100%. So we are comparing apple and apple. So I coded this strategy, and I'm sorry, I'm not going to reveal the code. If you want to know what a code looks like, just go to the previous episodes. We provided a lot of examples, but I code a strategy, and I so-called backtest it. So the algorithm, I can see the whole table during the last 5 years, what it looks like, and I backtest the whole idea, and I can see what would happen with my money during that 5 years. And here with this particular strategy, and now drum roll, let's see what would happen with algo trading strategy. So this algo trading strategy alone would make $23,000 in 5 years. And the drawdown, that's the first line, total net profit. And then the drawdown, which we can see the table below at the very bottom, maximum drawdown, the value is 1,825. So it's about 2,000. The drawdown is about 2,000. So this is what would happen with our 10,000 investment if we traded this one particular strategy. So if we summarize this, let's see what happens, how we can compare investment into Spider and algo trading strategy. We both can start with $10,000 equally. There's no difference. The market would make 47.88% return in 5 years. The algo trading would make 230%. So that's a huge difference. We're talking almost 5 times more. So your return would be nearly 50% per year. Now the drawdown of the Spider was about 40%, 3,960. With algo trading, it was 1,825. Actually, we cannot say it in percentage because we don't know exact point from which the drawdown happened. But overall, just very clear, very simplified version. The return risk ratio with the Spider would be 1 to 1.1, and with algo trading 12.6 to 1. Now,
wow,
for me, this is like, yeah, awesome, right? Now, for many, let's get down to the earth. For many people, this is too good to be true. They're just living in the paradigm of what TV tells them and banks tell them. So for a lot of people, this is hard to digest. And a lot of experienced traders tell you, but you will have slippages, you will miss trades, you will have poor executions, maybe the strategy will fail, or anything can happen. And I'm saying that's fair enough. So let's now do something radical. Let's just cut off 50% of all the algorithm trading profit. Let's say, okay, 50% will go away because of whatever reason you think. Even after slashing the result by 50%, we still have results which are way better than market. And now we're down to the earth. We're not, trying to make a heaven and, pitch you something nonsensical. We're doing what a lot of actually professional algo trading traders do. They look at the pessimistic side. Even if I would go 75% down, 75% worse results, we still would be better than the market. Even if we take 75%, we just write it off, we still would be better than market. So from my perspective, there's no question whether algo trading can or cannot beat the market. It can. It's like easily. The question is how much you will be able to beat the market. And some algo traders are better. They beat it a big way. Some traders just beat it tightly, but still beat it. So that's my example about beating the market with algo trading strategies.
And what about those algo traders who don't beat the markets? Maybe they've underperformed.
That's a brilliant question. Yes, that's very true. There are algo traders who have years where they do underperform, and there can be a couple of reasons. Actually, there can be many reasons. But if we talk about professional algorithmic traders, usually they are able to pick up the next year. So in algorithmic trading, we can see the phenomena that we have years where the market is really strong. It can make 20% move up, and the algo trading can be just 15%. But then we have a next year where the market can be -5%, and the algo trading can be still 15% up. So I think we have to see this on average. Doesn't mean necessarily we will beat the market every year. We need to see how we, see it from an average perspective. But on average, again, no hesitation about the claim that algo trading does beat the market.
And why did you choose 5 years in this study?
I wanted, I had a little bit of problem with I was using the Yahoo data, and they didn't have 10 years. They had either 5 years or the entire history. So that was a little bit That's a silly reason, but it's a little bit my laziness. Yeah, we can do it on 10 years. We can do it on 2 years. The numbers will probably be similar. Yeah, so that was the silly reason.
Yep. Well, that makes sense. It's fair enough. I'm sure the numbers will be similar across all kinds of different time frames.
Yeah. Now, what I would like to add, if I may, one more thing. We were just now we were comparing just in Spider with EMIN S&P. The important part about algo trading is that we can also diversify massively among products that have nothing to do with index. We can, especially in futures markets, we can diversify across other commodities. And that's a very strong point, because when this overall market goes down, Spider goes down, it's difficult to pick up with some possible profits. It is less challenging with a well-diversified portfolio of algo trading strategies, where we also have other products included and where we also can trade shorts, especially in breakout trading. By the way, if we move to the next slide, if you guys think about starting with algo trading the easy way, I strongly recommend start with this book. That will give you all you need to do to start with algo trading today. So that's it.
Excellent. So I think what we've seen in your research today, that it is possible with algo trading to beat the market, and you can beat it by a long way, but there's no guarantee that you will, right? So you've got to.
There's never guarantee. Never. There's
so
a good
you've got
chance.
to do it in a specific way. There's a good chance. Yeah, it is possible. So
it is possible,
and a lot of people do it. So
yes. The question at the beginning was, can algo trading beat the market? And the answer is it can, and it can do it spectacularly, but there are no guarantees in trading whatsoever.
Yep. Okay.
Nor in investing, nor in Spider. There are no guarantees in this world anymore.
No, we might see 5 down years in the markets now, right? Who knows?
Yeah.
So I just wanted to say that because, we need to make sure that we're giving unbiased, results. And so you can and probably will lose money algorithmic trading. So we don't have the SEC knocking on our doors saying, what did you tell everybody? All right, Thomas. So
yes.
any
no guarantee.
Yeah, no guarantees. That's right. So any final words before we finish up?
I would say just, if you're tempted by algorithmic trading, you're good with computers, you like coding, there's no reason why you couldn't give it a chance. First of all, you can try it with even fewer than $10,000, because we have micro contracts, so a couple of grants, and you can test if this is for you, if you like it, if you can work with this one. And second, I would also encourage people not to be afraid to get out of this paradigm of indexes and index investment, because it's not the golden mine. There are different, like we're living in an age of ChatGPT. So we're living in the next future. We're living in the algorithmic world of clever algorithms. And I think this world will be more and more interesting and offering more and more opportunities. So just give it a try.
Yep. And please, if you've enjoyed what Thomas has shared today, give us a thumbs up on the video and make sure you subscribe so that you get notified for any new content that we release on the channel. And so now, Thomas, the last couple of episodes we've recorded have kind of been, I guess, more of an introduction to algorithmic trading. Is that going to continue, or will we be going? What do you think we'll be doing in the next couple of episodes?
Yes, Andrew, you're very right. So mostly in this channel, we cover specific tips and tricks for people who already want to progress with algo trading and start creating their first strategies. And now we divert it a little bit because we wanted to also share some fundamentals. So the good news is we're going back to tips and tricks, how to actually build strategies and hopefully make as much money on them as possible. And sometimes in Meanwhile, sometimes we might still intersect with an episode with these fundamentals, because we believe it's also important to have an open mind and eyes about this and see what is possible and how it's possible. So there might be a little bit of a mixture, but yes, we're going back to practicalities and to help you guys to be as good algo traders as possible.
What an excellent way to wrap up the show today, Thomas. Thank you. I couldn't have said it better myself. So make sure you join us at the next one, PTA Live, in 2 weeks' time. Thanks for joining us.
Happy trading. Bye.
Happy trading.